You've got Deutsche Bank with an estimated $72 trillion in derivatives exposure. Deutsche Bank is the sixth largest bank on the planet and the biggest bank in the Euro bloc.
Investors today face an unprecedented level of risks. Currency risk, major market indexes, natural deflationary forces, and endless money printing from central planners. Meanwhile, most savers today are being told to stay the course, with high commission products and risky investments dependent on fraud. There is another way forward with peace of mind investing, a financial strategy with 4 key principles: safety, income, currency risk, and finding cash-gushing value investments. Learn more about these financial strategies at fmtadvisory.com/income.
Hello, everyone, and welcome into CrushTheStreet.com. I'm here with a returning guest, actually a favorite. His last interview we did was very well reviewed, and the audience really appreciated him quite a bit. So I wanted to have him on. His name is Jim Comiskey. He's with IFG Futures Group. He's got a YouTube channel, Jim Comiskey Metals. And, you know, if you missed last interview, you definitely need to watch it. We talked about collapsing oil, global depression, and higher metals prices, which are all happening, by the way. So Jim is super smart, and I wanted to have him on today to expose what is arguably the biggest scam in human history, and that is the banking industry and all their speculative bets in derivatives. So first of all, Jim, thanks so much for coming on the show.
It's a pleasure to be back and Crush the Street. Absolutely.
I've been looking forward to having you back on and discussing, you know, this topic, because I couldn't think of a better person to talk to about the banking industry than someone who has been immersed in the markets for so many years. And you got a lot of knowledge. And, you know, with, you know, Wall Street speculation, number one, Bernie Sanders talks about this. It's a hot button topic, and probably one of the only things that he says that I actually agree with. The Bank of International Settlements estimates around $1 quadrillion in global derivatives out there. So, you know, I'd like to get your thoughts, and maybe you can lay the groundwork here for, you know, the big banks and their involvement with derivatives.
Totally cool. Again, Kenneth, thanks for having me back. It truly is a pleasure and an honor to be back talking to your members, your viewership, your listenership. But dude, did you just call me like really smart?
You're a smart guy.
No,
you're a smart guy.
Okay.
All people need to do is listen to you, and they will know that you're a smart guy.
All right. Well, yeah, I've been doing this a long time, as you know, and perhaps you've got some new people that haven't listened to me before. We had almost 14,000 views the last time me and you spoke. Again, Kenneth, it's an honor. But in terms of the big banks, okay, see, let's just cut straight to the chase, okay? And I'm going off the top of my head here, okay? My notes are actually elsewhere. It's been a busy day. Okay, you've got Deutsche Bank with an estimated $72 trillion in derivatives exposure. And Deutsche Bank is the sixth largest bank on the planet and the biggest bank in the Euro bloc. And so let's put that into context. They've got $72 trillion in exposure vis-a-vis risk assets, if you will. And the GDP of Germany, the official gross domestic product of Germany last year was like $3.9 trillion. Now, Deutsche Bank has $72 trillion in derivatives exposure. Let's talk about negative interest rates. And Kenneth, I want you to seriously jump in when you want to jump in, because me and you are starting to get a good rapport here.
Jim,
it's good.
So what are the banks doing? They invest in these derivatives, and they're doing it for profit, right? And so what are they investing in? How are they able to do this? What are they investing in?
Okay. Now that's an excellent question. And what I'm going to address here, initially anyway, is the yen carry trade. Okay, what a lot of banks are doing is they're borrowing in yen at negative interest rates, and they're deploying the proceeds into U.S. stocks. Now, by negative interest rate, it's a bit frightening, because bottom line here is a normal yield curve. And hey, if you want to interrupt me, do so, please, Kenneth. A normal yield curve is upsloping, which means the street is looking for that sovereign to have economic growth. Okay. Because they're going to demand a higher yield going out 30 years. Typically, the longest duration on a yield curve from a sovereign is going to be a 30-year bond. Okay. And but what's happening here, and what happened yesterday, which was highly, highly unusual, was the 10-year note and the 30-year bond in the United States. And I'll get to the bank's exposure, but if you allow me, Kenneth, there's some background that I need to address here.
Sure. Yeah, absolutely.
You cool with that?
Yep.
Okay. Right. Okay. So let's start out in Asia. Okay. The Japanese 30-year bond, the equivalent to our 30-year bond in terms of duration, yielded a record low on yesterday, Monday actually, of 0.492%. So you're paying to borrow from the Japanese government just for safety of your principal. It's no longer about return. It's about return of principal, as much principal as you can grab, because investments don't yield anything anymore. And this is the great Keynesian experiment. Okay, so you've got Citibank yesterday announced that they were going to cut, they're going to net 25% less than they did last year on year. And basically, it's a situation where rates are going to go negative in the United States. In my opinion, Kenneth, in my humble opinion, it's inevitable.
So they're doing.
Rates are going to go negative.
So can they have their derivative exposure and continue to invest the way they do and speculate the way people are calling it with rising interest rates in a rising interest rate environment?
Yes, and then there's a very simple answer to this. And and I know your listeners are quite educated, because the comments that I've gotten from our last rant, if you will, when Glass-Steagall was repealed in 1997, and it had everything to do with Alan Greenspan and Hank Paulson. Hank Paulson, him formerly of the Vampire Squid, Goldman Sachs, who was Treasury Secretary at the time. Okay? And they repealed Glass-Steagall. Now, Glass-Steagall was an act that was written into law in 1934. I might be off by a year or two there, but I think it was 1934, which did not allow banks to use depositors' funds to speculate in the markets. Mm-hmm. Well, now this act was repealed in 1998, in other words, all of a sudden, Kenneth, me and you, our money that's in a bank somewhere, currently can be used, margin-wise, it can be used like 9-to-1 in terms of, say you got $100, they can trade that at $900.
Okay, so I want to stop right there. So that's very important.
Please.
Our money is being leveraged 9-to-1 by the banks. So, what could happen to disrupt their speculative investments, and how does this trickle down into the economy? Why are people concerned about banking speculation? I'll let you answer it that way.
Totally cool. Again, a salient point and a great question, Kenneth. Basically, they're overextended. Basically, we've got like 5 majors now. We got really 5 big banks in the United States. Okay, nothing has changed since 2008. Nothing was fixed. No one went to jail. So we got J.P. Morgan. We've got Goldman Sachs. We've got Morgan Stanley. We've got Wells Fargo. And, we basically have the cabal in Midtown Manhattan who is using our money, over-leveraging it. And if rates start to turn north, which they're probably not going to anytime soon, because I think the Fed's made a mistake and they're going to be on hold for a while. I still think that crude oil is going down to $20, $18 because demand just isn't there. If you look at, say, the Baltic Dry Index, you look at some leading indicators, the Baltic Dry being a shipping index, Panamax, Capex, Supermax, it's a measure of global trade, if you will. And I actually have a friend and a customer who worked in the oil industry, and he says one of the biggest storage facilities for U.S. crude oil is in the pipeline system itself, not on ships sitting offshore, which costs money. If they reduce the volume flow to like 0, they're just storing all the crude oil that's being produced in the pipeline system, ready to offload once demand picks up. Now, I'm going to address your question about banks because it's highly relevant. And it's not just like, your big 5 in the States. They're over-leveraged with, say, the Balkan shale companies, the fracking companies. It's also European banks, most notably Deutsche, Royal Bank of Scotland. You've got UBS, United Bank of Switzerland. You've got Mitsubishi out in Asia. They have huge exposure to the shale drillers, the frackers in, say, North Dakota south of there, in the States. And those frackers are due to roll an estimated, wait for this now, I've seen it from 3 sources, $4 trillion worth of debt they got to roll. But it's all predicated on crude oil being at like $70, $65 a barrel. Well, as we all know, crude is at like 37 a barrel. So when they roll these loans over, and the thing is, Richard Fisher, president of the Dallas Fed, actually had made a statement urging the lenders that are over leveraged to the shale producers in the States to not to market their actual debt once it has to roll over. And that's just not only highly unusual, that is basically doing like an Enron, where we're offloading. This isn't on our balance sheet anymore because the Dallas Fed requested that we do not put this on our balance sheet anymore, mark to market. In other words, huge losses, recognize huge losses. because it would be too precarious in terms of, market movement. But, the chatter is getting louder and louder and louder.
Jim, you really pointed out there and articulated how we are more addicted than ever to growth in the markets, and with all this margin and leverage and low interest rates and any slowdown in the global economy, which we are seeing, is this what could be that bubble burst, and what kind of collapse in the derivatives market could we see here?
Again, Kenneth, you're getting really good at this, dude. You really are. And I'm not denigrating you by saying that. You're getting really sharp here. I'm gonna harken back to an episode that occurred in, I believe it was 1983, 1984. I'm a big student of history. Because if you don't learn from history, which we never do, because there's not enough people that study history, you're going to repeat history. It was a little boutique shop called Bevel Bressler. Okay, and it reneged on some overnight repurchase agreements with your J.P. Morgans and Solomon Brothers at the time, who was big, and your Merrill Lynch's, who were the biggest, well, almost. And all of a sudden, they reneged on just like $100 million, not just, but this was in like mid-'80s, $100 million worth of overnight repurchase agreements. And this whole thing snowballed to the point where the governor of Oklahoma, the state of Oklahoma in the United States, had to declare a 1-week banking holiday. In other words, no one could take any money out of their bank account because this little boutique shop, I believe it was located in southern Florida, reneged on $100 million in repos, and it snowballed. Now, imagine this. Okay? Imagine Deutsche.
Wow.
Blowing up. Imagine this. And so the counterparty risk, Kenneth, to your JPs, your Goldmans, your Royal Bank of Scotland, your UBS, your Warburgs, your Mitsubishis, all of a sudden, the counterparty risk is going to spread and manifest itself in a similar fashion that the MF Global debacle in on 11/11/11, it basically trashed the markets. I think. Okay, go ahead. I sent you that. You want to ask a question? Go ahead.
You know what? I was gonna. Go ahead. No, I was going to just ask you what does this mean for the average working man? Does this mean that his home price is going to go down? His stock market, what he has in his 401k is at risk. How does it apply to the average person?
Here it is. Okay. Now, I assume that all your listeners were able to hear what you just asked, so I'm not going to repeat it, right?
Yeah, everyone heard that.
Okay. Awesome. Okay. How this applies to your average man. Okay, remember in 2008 when, we looked aghast at our 401ks and our perhaps speculative account, trading stocks or, maybe an IRA or maybe whatever. And we got absolutely smoked. The Muppets got smoked.
Yep.
Okay. The way, Kenneth, in my humble opinion, the way to protect yourself, particularly in this environment, is by being long gold, being long silver, being long real estate, and yes, this is going to sound perverse, but also being long the U.S. dollar. Now, in this environment, gold has rallied $200 since like late December, which is a significant move. Silver has lagged. It's my opinion that The reason silver has lagged is because silver is used industrially. About 40% of the above-ground silver is used in like cell phones and solar panels and things of that nature, and they end up in, scrap heaps and junkyards. So it's indicative of the market, like the Baltic Dry, okay, anticipating a huge economic slowdown because the industrial use of silver is no longer going to be as huge as it was, because no one wants to buy solar panels anymore. Cell phones are slowing down. Apple reported, by the way, like last week, the first time ever that iPhone sales have dropped off year on year. So the average guy, I'm sitting there. What do I know, right? Mm. I'm no genius, but as Aristotle said, like 3,400 years ago, a wise man admits he knows nothing. Mm. I've been doing this 34 years, and I learn new things every day. And the only way, because the central banks the world over, in conjunction, Kenneth, with the majors, the biggest banks in the world, have basically colluded to go with negative interest rates in an effort to stimulate consumer spending. No one wants to spend when the bulk of jobs that are reported, say, in the United States, are bartenders and waitress jobs. Those people, and I'm not denigrating any bartender or waitress. I love you guys. Right?
Well, of course.
Can you afford a $350,000 house and 2 cars and 2 washing machines, dishwasher, whatever, a microwave, an oven, on a bartender or waitress salary? No. What I'm alluding to is durable goods. We are at an all-time high in terms of rental in the United States vis-a-vis home ownership. And this is all part and parcel of what occurred in '08, and nothing's been fixed, nothing's been cured, and the little guy just continues to get his nuts squeezed. And, according to, the Bureau of Labor Statistics and the Commerce Department, well, consumer price index is like 0. There's no inflation. Really? Have they paid a college tuition bill lately?
Jim, on that note right there, I don't know if you saw the headlines this morning, but this is the 7th. We're doing this interview on what is the 7-year anniversary of when the bull market started on March 9th, 2009. And
you noticed that, did you?
I did notice that. Yeah, it was I was interested. And I guess they're not calling it a bear market yet because we haven't corrected by 20% yet. So things are still good. Now, to give the article some credit, they were calling it the most hated bull market on history because I think people have very vivid memories of what happened in 2008, and they know things are on shaky ground here, hearing the global news, oil collapsing,
right.
The people that they know unemployed, the cost of living. I tend to think that Janet Yellen is going to do what she can, because she is a Democrat, to keep the stock market together at least until the election, because I think it would hurt the Democrats' chances to be able to win. Go ahead.
No, finish your thought.
No, I was just saying. I think I'm not a hardcore Republican or anything. I lean libertarian,
right.
But I tend to think that Janet Yellen is going to try to keep this thing together and give Hillary a chance here, because if the stock market collapses on a Democrat watch, it might give the Republicans a little more momentum. So your thoughts?
No, I like that. Okay, you know what? There's really 2 things we shouldn't talk about right now, dude. I'm old school, but that would be politics, and religion. All right, so let's just... the Fed is supposed to be apolitical, and you know and I know they're not, okay? That's neither here nor there. But let's just harken back to one of the first things that Helicopter Ben Bernanke did in '06 when he took over the Fed. All right? The first thing was all deposits that, there's currently 21 money center banks, that can borrow from the Fed at the discount window, okay? They're called primary dealers. And when they borrow at the discount window, it used to be a stigma. It meant that the bank had issues. But now they're borrowing at 0%, in essence, 0.25%, and they're re-lending it to the Fed. They're keeping it on the Fed's books, and they're giving it an automatic 25 basis points of joy in that trade. So the money, the Fed's balance sheet, if you can do this, please, if you guys can do this, put the Fed's balance sheet and the S&P 500 on the same chart since '08, and they match tick for tick for tick for tick. Because primary dealers are borrowing money at zero, they're throwing it into stocks, and they're just walking away guaranteed, knowing that they are winning trades. Now, the yen carry trade works part and parcel with the same trade, because they're borrowing it like almost 0%. And the Fed wants people and banks and sovereigns to take, and all central banks, to take extra risk in order to try and stimulate the economy and get people spending again. But you know what? If the jobs aren't there, people are not going to be spending money like they used to.
Sure.
And therefore, all the banks that are on the hook for all these really high yield, basically junk bond type loans, most notably to the oil majors. By the way, ExxonMobil announced a couple days ago they're cutting their capex, their capital expenditures to this year 25%. That'll be like a 3% decline in U.S. GDP right there. They used to be the biggest company by market cap, until the tech companies took over. And how's that trade working out for you?
Wow, that one company cutting capex by 25% will lower U.S. GDP by 3%. And that, like you were saying earlier, $150 million issue back in the 1980s spurred a major crisis, a bank holiday. And, there's just a lot, there's a lot of things that are bubbling right now in the economy. So, wow.
Exactly.
So Jim, gold's hitting 52-week highs here. Precious metals are on the rise. Let's get your, kind of closing thoughts here with precious metals.
Totally cool. All right. If you're still stacking, okay, what I would recommend at this stage, and I've always recommended this kind of, don't put more than 10 to 20% of your investable net worth into precious metals, but it's a way to protect the dollars that you've earned over your career, okay? So you need to have that physical, in my humble opinion. Now, at this stage of the game, gold has run so far, so fast. I think silver is a better value at like $15, $14, $15, $15. We go back to Sir Isaac Newton, okay? Mm-hmm. And his original silver-gold ratio was 15.5 to 1. Right now, the silver-gold ratio is over 300 to 1.
Wow.
The definition being how many ounces of silver in local currency, in dollar value, does it take you to buy 1 ounce of gold? Okay, it used to be 15.5 ounces of silver to 1. And now it's like 300 ounces of silver to 1 ounce of gold. So I think a nice long-term type of play would be to start stacking silver physical, either directly through the U.S. Treasury, or you can go through CAD, you can go through Bank of Canada, or and start stacking up on Maple Leafs, or you go out to coin shows and look for Morgan silver dollars going back to the 1880s, early 1900s that are in good shape. It's an ounce of physical. It has meltdown value, but it also has numismatic value. All right, so I think silver's the way to go. If you don't already own land, or if you're not in a position to own land, buy physical silver.
Jim, I really do appreciate. You know what? It's good advice. There obviously we could talk a lot about how to structure our finances. I mean, being debt free, and not so exposed to the way the economy is. Being dependent on the economy is what's going to be a problem for people, and the more you can separate yourself from the dependency of a growing economy, I think the better off you're going to be. And I think you hit the nail on the head with your advice there. So if people want to reach out to you, Jim, and learn more about what you do, where would they go and what would they find?
Okay, yes, sir. I do a YouTube rant. Generally about 3 or 4 times a week. It's just Jim Comiskey Metals.com. That's COMISKEY Metals.com. And I give you my geopolitical views on why I think that the PMs, the precious metals, are going to soar. And they're going to soar, in relative terms. Okay? And I don't want this to really happen. Because if it does happen like I'm envisioning, that means the world economy is going to hell in a handbasket. Well, personally, I feel as though the world economy is going to hell in a handbasket. And so let's do this now. You have all my contact information there, Kenneth. I'm looking for a business card, and I'm currently, I apologize for this, but I'm in a hospital waiting room waiting on my mom. She had issues with her hip.
Oh, gosh. Wow.
Well, no. We're good. But I don't have a business card on me. So, people, please, refer to my 1-800 number if you're in the States. It's free. I'm sure Kenneth will post it. If you're outside, or if you're outside the States, rather, call me on a 312 number. And my personal email address at IFG is just jim.comiskey at ifgfutures.com. And shoot me an email. I love comments. I love questions. I endeavor to answer all comments and questions. People, Muppets, Army of Comiskey, we are all in this together. I'm a guy that's been behind that curtain for 34 years, and I know what the big boys are doing, because I have a lot of friends and customers that are big boys. And so please give me a call. And, we'll try and hedge up your physical if you currently have a big stack, or we'll try and speculate. No guarantees, but it's as simple as that.
Jim Comiskey.
I'd love to hear from your audience.
Absolutely. Everyone, that's Jim Comiskey. He's got a lot of knowledge, a lot of understanding of the market, a great history of working in the markets. Yeah. And Jim, wow, I didn't realize you were in a hospital waiting room. I do hope everything is okay.
But dude, it'll be okay. She's okay. But we've had this, this interview scheduled for like 2 weeks, and I didn't want to back out. So that's why I had to push it back. Remember, we were originally going to do it at like 9 this morning, 10 this morning, whatever, and we did it at 12:30. So it works.
Absolutely. Like I said, I do appreciate it, and I do wish your mom the best and the situation.
Thanks,
so
I appreciate that. But again, what I want to reiterate is we're all in this together. Okay, there's a certain element in the markets that doesn't care a whit about me or you, Kenneth, or anybody listening to me currently. I'm on the other side of that coin, because the better my customers do, and my friends do, and people I talk to do in the markets, the better I do. I'm into long-term business relationships. I'm not into, like, Goldman Sachs, sell me your gold because it's going to 900 as they buy gold as it goes up to 1,300. Really? How's that working for you?
Mm-hmm. Understood, sir. Understood.
Kenneth, as always, dude, it's been a ball. It's been a ride. It's been fun. I look forward to talking to your peeps. And you know what? Again, we are all in this together. And that's basically the bottom line, and that's a great way to end this interview, I guess.
Thanks so much, sir.